are here to continue our discussion on the topic of analysis of financial statements. This is going to be part 2 of our discussion on analysis of financial statements, and in the previous lecture of mine I told you about the horizontal analysis, and in that we talked about the comparative financial statements, wherein we learnt how to prepare comparative income statement as well as comparative balance sheet. So extending our discussion with that horizontal analysis, we are now going to discuss about trend analysis. As the term itself is indicating that we are trying to find out the trend in some of the items of our income statement or in balance sheet. So it is basically called as another form of comparative analysis of financial statements, and it is going to indicate the trend of individual items of financial statements over a period of time. And when we are conducting this kind of trend analysis, it is quite helpful in present and future policy making. So the first question which comes in your mind is, what are the steps in trend analysis? How do we conduct trend analysis? From where to start? How to begin with? So first of all, in order to start our analysis, which is called as trend analysis, we have to identify, we have to select or choose a year as your base year. While selecting the base year for my trend analysis, we have to keep in mind that we should not select, we should try to avoid those years in which we have witnessed certain abnormalities in terms of your sales or in terms of your profitability or in terms of your expenses. So if you have witnessed any kind of abnormality into your profitability value, your income statement or your balance sheet, you should avoid selecting that year as your base year. So base year should not have any kind of abnormality, and if it is there, that need to be taken care of, that need to be adjusted with. And after that, what we do, we calculate trend percentage, and eventually, of course, the inference is supposed to be drawn based on the trend patterns and also the absolute values. So we can have a graphical presentation of our trend analysis, we can have the absolute figures for that trend analysis, and we can draw inferences out of that data. We can add meaning to that data, whatever is provided to us. So trend percentage, basically they reflect several years financial data in terms of a base year, and normally base year is provided with the value of 100. It equals 100%. We assume the total value to be 100, and that is regarded as a base. After that, we try to calculate trend percentage. Very basic formula we have for it: current year value divided by base year value into 100. So suppose if I am conducting analysis of 2021, my base year shall be, and base year is 2020, so I would take up current year value, that is of 2021, divided by 2020 data and multiplied by 100, because I want my answer in terms of percentage. But remember, for the subsequent year, my base year shall remain the same, only the current year value shall change. So once I have chosen my base year, that I am not supposed to change, because that is going to show me the cumulative change, that from base year what is the ultimate change, what is the eventual change. So I would try to show an example here. For instance, suppose I am showing you the income information for the year 2001 through 2005 for a company. So the sales value is given, cost of goods sold is given, gross margin is given. Now from 2001 to 2005 the data is given, and here we have assumed the year 2001 to be the base year. Then of course the amount, whatever, suppose if I am taking the sales value, so while preparing the trend, conducting the trend analysis, the value of 2001 shall be considered as 100, because I am taking it as 100%, and in proportion to that I shall be doing the calculation. So it would be like this: suppose if I am taking the value of sales for the year 2001 to 2002, so in the first year what I will do, I shall take the amount of 2002 and I shall divide it by 2001 amount, because that is the base year, and then multiply it by 100. So if we look at the value of sales in the year 2002, it is 2,90,000, whereas in case of 2001 it is 2,75,000. So the current year value is 2,90,000, that is here, and it is supposed to be divided by the base year value, that is 2,75,000, multiplied by 100, and it is giving me the percentage called 105%. So I am getting the value of 105. I shall write here in 2002, in the column of sales I shall write 105. For For the second value, cost of goods sold, the same process shall be followed. We shall take the value of current year, that is 2002, 1,98,000, divided by the base year value, that is the value of 2001, 1,90,000, into 100, it is giving me the value of 104. For gross margin, the same process when we follow, we get the value of 108. So from 2001 to 2002, we have done the calculation. Likewise, we shall do the calculation for the subsequent year, that is 2003, 4 and 5. And when we do the calculation, we find the trend percentage like this. So if we look at, say, if we take the example or instance of sales only, so what 100% was in 2001 and it has become 145% in 2005. So across the period of this 4 years, or you can say from 2001 to 2005, your sales has increased to the extent of 45%. So if it was 100 in 2001, it has become 145, and the speed of cost of goods sold is also 150%, and gross margin is 135%. So if we try to analyze this trend, we can find that cost of goods sold is increasing faster than sales. If you look at the percentage of 2005, the speed of cost of goods sold is 150%, whereas in the speed of sales is 145%. So if I try to find out the reason for my reduced gross margin, or you can say which is not speeding at that pace at which my sales is increasing, the reason can be attributed to the speed of cost of goods sold, because the speed of cost of goods sold is much higher than that of your sales. So that can be a reason. So by this trend analysis, we can easily find out the item wise meaning to this value. We can add meaning to this percentage, that see, sales, if it was supposed to be 100 in 2001, now it has become 145%, which is positive. Cost of goods sold, which was 100 in 2001, it has now become 150%, which is of course a matter of concern for us. So we should try to reduce it. And gross margin, it has not increased with that pace at which my sales is increasing, so that is also a matter of concern for me. And if we try to plot it graphically, we find the figure like this. We have the figure of sales, cost of goods sold and gross margin, and we can find that the speed of sales is high, but the speed of cost of goods sold is greater than that of sales, and that is why that curve has found prominence here. So even graphically we can draw interpretation, we can draw inference out of this analysis by plotting these values into this graphical diagram. We can find that what is the trend, how this trend line is being drawn, in what direction my sales, COGS and gross margin is moving. Now, what is the advantage of trend analysis? That is a question in front of you. You always ask that, sir, what is the point of conducting trend analysis? The benefit is that it is quite helpful for you in analyzing the growth pattern. And graphical presentation of trend line is of course helpful in instant decision by the management, and that is why we call this technique to be a very useful technique in the hands of management accountants. But there are certain limitations to this trend analysis, and that is why we need some other techniques as well. Selection of base year here is a very important step. Suppose if somehow you are committing a mistake and you have mistakenly chosen a specific year as base year where lot of abnormalities were there in your financial statements or in your balance sheet, then of course your trend is going to be misleading. So whatever trend line you are trying to draw may not give you that meaningful direction which you were expecting to, or with which motive you started your trend analysis. So selection of base year is very significant or important step in this analysis. You should be very careful while choosing an year as your base year for trend analysis. At times, another drawback of this is at times it is difficult for you to identify the impact of inflation on trend data, because you are not trying to show the impact of inflation. For that we need to conduct further analysis to include, to accommodate, to assimilate the impact of inflation on your trend data. not only inflation, even the changes in market conditions, they are not considered in trend analysis. So that is another drawback of this particular technique called trend analysis. So trend analysis, despite these 2-3 limitations, it is one of the most useful technique or easiest technique of making a comparison or adding value to your data or adding meaning to your data. It is still increasingly being used by most of the management accountant. So in horizontal analysis, we have discussed two broad techniques. One is comparative financial statement, another is trend analysis. Now we shall move on to vertical analysis. As the term indicates, that whenever I am conducting vertical analysis, it means I am basically standing on the y-axis, or you can say I am doing the analysis vertically, and we are focusing on the relationships among financial statements items of financial statements at a given point in a time. Suppose if I am having a balance sheet of 1 year and trying to somehow find some relationship between the two component of balance sheet or say income statement, that can be called as vertical analysis. Most of the time when we ask this question to our students, what is vertical analysis, their answer is, sir, ratio analysis is vertical analysis. Yes, of course, in ratio you are trying to find the data from the balance sheet or say from the profit and loss account, and we try to calculate different types of ratios. It can be solvency, activity and profitability. We have discussed ratio in great detail in the previous lecture, that's why I am not repeating it again here. I shall now be telling you about the common size financial statement, which is again called as or categorized as a vertical analysis, in which what we do is each financial statement item is expressed as a percentage. So we try to provide a common size to our financial statement, and then we conduct this kind of analysis, and that is why we call it vertical analysis. But we have to understand that we have to remain within the vertical. We are not going to move horizontally, so it is not going to be what you call as intercompany comparison, or what you call as the inter or across the period analysis. So common size statement, when we have to define it, we say that these financial statements, it is a vertical analysis in which what we do is each financial statement item is expressed as a percentage. So we are trying to show each and every item in your financial statement in terms of percentage. So suppose if it is income statement, if it is profit and loss account, all items are usually expressed as a percentage of sales, because when we are working for this profit and loss account, or what you call as income statement, we are basically taking sales as base, whereas in case of balance sheet the base differs. So suppose if I have to calculate gross profit percentage, very simple, it is gross profit divided by sales, and it is basically indicating how much of each sales in rupees left after deducting or subtracting the cost of goods sold. Whereas in case of balance sheet items, all items are usually expressed as percentage of total asset. So we take total asset as base when I am dealing with the balance sheet for the purpose of this common size statement. So cutting short the story, in a common size statement, what we do is all the figures are expressed as percentage of a base value. As I told you, for profit and loss account, the base value will be sales, whereas in case of balance sheet items, the base value shall be the total asset. So for instance, suppose in a common size profit and loss account, we have to prepare this common size profit and loss account. Each item in the profit and loss statement can be expressed as a percentage of total sales. Likewise, in balance sheet, what we do, we take the denominator of total asset. Total of the balance sheet may be taken as a common denominator. Now these common size statements, basically they offer us a relative importance of various items, and they are helpful, quite helpful in establishing a broad trend. So suppose if I have to show an example of common size statement, suppose there are two companies, ABC and XYZ Limited, and their net income for 2020 is reported. Suppose if it is 219 crore rupees for ABC Limited, so percentage is written here that out of total the total sales, since it is net income, 8% is basically my net income, whereas in case of XYZ Limited it is 5.80%. it would be more clear when we take up an example to understand. So let us take another look at the information from the comparative income statement of a company called LK Limited for 2020 and 2021. So if you look at this comparative income statement of this company, the figures of two periods 2021 and 2020 is provided to us. Now here the last two columns are very significant for us. That is where we are adding common size percentages, and if you look at sales, I have written 100 in 2021 and the same value is written in 2020 also 100. Why so? Because we are considering sales to be 100. So sales is usually base and it is expressed as 100%. So we are writing sales as 100. Now henceforth you will understand what we are doing in common size percentage, what we are going to do here. Unlike comparative statement where we were taking the value of base year, current year divided by base year, here we are, since moving in the same vertical, so we have to keep this thing in mind that when I am dealing with the data of 2021, I shall only be focusing on the value of 2021. So 2021, suppose I have to do the calculation for cost of goods sold. So take up the cost of goods sold of 2021, that is 3,60,000. divided by the sales of 2021, that is rupees 5,20,000, which means you are moving in the same vertical, you are not going to cross your limit. So 3,60,000 divided by 5,20,000, and in terms of percentage it comes to be 69.2%. The same we shall follow for 2020 also. When we do the calculation, we find the value of 65.6%. My dear learners, here I would like to reiterate that most of the time my students are saying, sir, we could not find any difference between the common size and comparative income statement. You told us that it is not an analysis of 2 years, it is an analysis of only 1 year, we have to remain in one vertical only. And I still stick to the same logic, same analogy that yes, we are sticking to the data of 1 year only. Here the examiner has asked you to do the analysis, to do the calculation or prepare the common size statement for 2 periods, but you are not doing any cross comparison, you are not doing any comparison of data of 2021 with that of 2020. We are isolated, we are doing the calculation in the isolation. When I am talking about the data of 2021, I remain in the vertical of 2021. I don't move on to the data of 2020. So that is what is the point which you should keep in mind when you are preparing this common size statement. Now why do we call it common size? Because we are offering this total value to be 100, sales to be 100, and then the cost of goods sold is calculated. Likewise we do the calculation for each and every item, and here comes your net income. So your net income is no more in terms of rupee, it is now in terms of 3.4 and 4.7. So if anyone or everyone who is looking at this common size percentage, you have a question, what conclusion can we draw? Very simple. Out of sales of 100, your net income is supposed to be 3.4, and the most alarming part is earlier it was 4.7, now it has become 3.4. So with this analysis you have understood that what is the benefit of preparing this comparative common size statement, where we are trying to understand that what is the meaning of this data which is provided to us. So with the sales of rupees 100, earlier you were booking a profit of 4.7, net income of 4.7, but now you are not booking the same profit, your profit has reduced to 3.4. Now let us have a look at another problem. There are 2 companies, LKT and APT Limited, and they are reporting the figures of their sales, cost of goods sold, operating and non-operating expenses for the year 2021. Now here, to be very precise, I have taken, to be very specific, I have taken the data of only 1 year, just to eliminate your doubt that we are not doing any analysis of 2 periods. Sales of LKT Limited were rupees 5 lakh and that of APT Limited was rupees 4 lakhs. Cost of goods sold were rupees 3 lakh and 2,80,000 respectively for both the companies. Operating expenses were rupees 1 lakh and 40,000, whereas non-operating expenses were 50,000 and 40,000 respectively. Now what is required from us? We have to prepare a common size statement for these 2 companies, LKT Limited and APT Limited. Very simple, let us solve. Very simple to calculate. The two values, we have taken the absolute figures from the question or whatever information is given in the question. The first three columns are basically a representation of that. The calculation part is the remaining last two columns where we have computed the percentage of sales. So sales is supposed to be 100 for both the companies, and here is the point where we are offering it a common size. And then what we have done, the same process we have followed. Cost of goods sold is 3 lakh rupees for LKT Limited. If you calculate the ratio of 3 lakh to that of 5 lakh rupees sales of LKT Limited, you will find it to be 60%. Whereas if you look at the cost of goods sold of APT Limited, that is 2,80,000, and find a ratio of it with that of sales of APT Limited 4 lakh, it comes to be 70%. Likewise, when we do this entire calculation, at the end what I am getting, that both the companies are having the same level of net profit. So with the sales of 100, both are booking a profit of 10. This is what we get out of this preparation of common size statement. Now to clarify it further, let us have a look at another example of common size statement. I have strategically offered you a solution where we are provided with the data of 4 years 2014, 15, 16 and 17 for this sales, for this income statement. And if you look at the cost of goods sold, here the cost of goods sold constitutes about 60% of sales. This is what we are getting out of this data. And the profit after tax as a percentage of sales, it has fluctuated from 10.1% to 14.5% in the last 4 years. So if you look at the profit after tax, what is happening? Earlier it was 10.1%, now it has become 14.5%. So this is what we are doing. We are expecting from a common size statement. This kind of inference is readily or instantly available with the help of this technique that is called common size statement. If you look at the common size balance sheet, the value remains the same. Here what we do is we take the total asset to be 100. If you look at the very end of this statement, total assets value is given to be 100 for all 4 years. And here we can find that if you look at the property, plant and equipment, which is also called as PPE. So PPE have declined from 55.6% to 44.4%. So now you can draw an inference out of the data provided in the balance sheet. When it is prepared like this, you can easily find that earlier it was 55.6%, now it has declined to 44.4%. The same can be done for other items also. The cash which was 7.3%, now it has become 3.8%, cash and bank balance. So this is what is the beauty of this comparative what you call as common size statement. In case of liability side, the proportion of equity has come down from 50.6% to 49.6%. So earlier it was 50.6%, now it has become 49.6%. Long term borrowings, they have gone up from 17.6% to 24.9%. So this is basically the way we have to draw inference out of this common size statement. Now at times we are supposed to clarify what are the advantages of common size statement. You have already witnessed the kind of inference we can draw from this statement, but still I am explaining you what are the advantages of common size statement. Basically they exhibit a relative significance of each item in your financial statement. You can find item wise significance, or at times you can find the regions also. If you look closely without applying any ratio, without doing any further calculation, a simple glance at the common size statement is sufficient for you to understand the trend. It seems as if the data is speaking. It seems as if whatever is happening is being highlighted without any calculation. That is the beauty of common size statement. You can also conduct intercompany comparison. It becomes very easy for you. Even if you are preparing common size statement, both the companies are at par with, and you can draw intercompany comparison as well. It is also helpful in ascertaining the short term and long term financial position of a company. You can find out You can ascertain what is the short term solvency position of a company, what is the long term solvency of a company, without any further calculation, say called what we do in case of ratio analysis. And that is why, so see, it depends on the management accountant. It is completely your discretion either to choose ratio analysis or to go for common size statement. It depends. And most of the management accountants, they try to have as many tools as they are available. They try to start from the common size statement and eventually go up to the ratio analysis and further statement of cash flow and all. So this is the benefit of this common size statement. If you talk about drawback, of course, in order to provide some statistical value in place of simply giving the trend line or percentage, you can go for conducting ratio analysis. I also think of introducing another, and which is going to be the last component of this analysis, that is called indexed statements. It is just like what you do in case of index number in statistics. We study the index number. Likewise, we prepare indexed statement here. So here in index statements, what we do, we are basically expressing various components of the balance sheet and profit and loss account as a percentage of the base year. So remember, just like trend analysis, here too we have a base year and we try to witness the movement from base year to the current year. So in index financial statement technique, what we do is the base year figures are taken to be 100 and the subsequent years are expressed as percentage thereof. And the computation is done for each and every item. If you are doing it for balance sheet, all balance sheet items, and in case you are doing it for profit and loss account, all items of profit and loss account. So to be very precise, if you ask me what we do in index statements, we are expressing various components of the balance sheet and profit and loss account as a percentage of the base year. And it is very simple to understand. You can see here with the help of the profit and loss account, or you can say indexed income statement of a company, where all the values were given for 4 years, and we started from 2014, taken that year as your base. And if you look at the sales, which was earlier 100 in 2014, now it has increased to 130.5%, whereas the profit after tax has gone to 167.9% during the same period. So this is the way. So if you look at the index, 100 means the base, and your percentage should get increase in cumulative manner, and it has now become 130.5% as far as sales is concerned. The same process you can follow for balance sheet also, and it is quite simple to calculate. So need not to bother about further techniques. We can simply at times we can find solution to our small problems with the help of small techniques also. So here if you look at the size of balance sheet, which has almost doubled from 100 to 210.1%. So the size of balance sheet has increased, and that you can find simply from the indexed statements. The same kind of analysis can be done for liability side also. If you look at the liability side, the shareholders fund have gone up to by 206.3%. So what was 100 earlier in 2014 has now become 206.3. So with this we came to the end of the different techniques of analysis of financial statements, wherein we have understood what is vertical analysis, what is horizontal analysis, and I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.